Hello, Charles. Tell us more about the investment strategy of the fund and why should investors consider the fund?
Hello, thanks for having me. Rare Infrastructure is a manager that invests in listed infrastructure globally, and there's four main reasons why we think the sector is a great opportunity for investors. Firstly, there is significant growth in infrastructure globally. The outcomes of a sector being predictable, resilient cash flow mean you have good diversification benefits and very high income levels for investors, which is a very important characteristic as return expectations globally start to fall.
Does the geographical allocation of the Global Infrastructure Fund come about as a function of the companies that the fund invests in, or are the fund managers aiming for a specific allocation of countries?
Thank you. Primarily, we are a bottom-up fund manager, so all the stock outcomes are a reflection of our analysts' research on individual stocks. That said, there is some broad frameworks we invest in, regional, sector-specific frameworks, but as I said, it's really bottom-up driven analysis, which is the outcome.
Given the current rising interest rate environment, how would the fund be positioned to capitalize on that while maintaining a prudent risk management strategy?
Thank you. So interest rates are certainly rising globally, and the fund is well positioned to take advantage of that. If rates are rising because of growth expectations, then we can position the portfolio to more user pays assets like toll roads, airports and ports, which benefit as growth rises. If interest rates are rising because of inflation expectations, again, the portfolio has many levers where that's passed through, whether it's in terms of regulation or concession agreements. So interest rates rising are not really a bad thing for the sector.
What are the key investment differences between the Legg Mason Rare Global Infrastructure Value Fund compared to the Legg Mason Global Infrastructure ETF?
So the Legg Mason Global Value Fund is a long-only, actively managed fund, whereas the Smart Beta or ETF product is based on a series of rules which gets recut essentially every quarter. So a big difference. One is quantitatively driven using rules, and one is actively managed using a team of analysts and portfolio managers and investment committees making the stock decisions.
Thank you, Charles.
Thank you very much.